Good afternoon, everyone. Welcome. Welcome again to the South African Reserve Bank and the conclusion of the Monetary Policy Committee meeting. Since our previous meeting of the Monetary Policy Committee, the global economic outlook has deteriorated. Events in the Eurozone appear to have entered a new phase, with the focus moving from the peripheral countries to some of the larger economies in the region. The global systemic risks posed by any failure to overcome the sovereign debt crisis are enormous and are exacerbated by the potential failure to resolve the debt ceiling crisis in the United States. These events are taking place against the backdrop of a slowdown in growth in many of the advanced economies. The domestic economic recovery has continued, but in a hesitant manner. The strong performance of the economy in the first quarter of the year is unlikely to be repeated in the second quarter, and growth prospects will also be dependent on global developments. Domestic inflation has been increasing in line with expectations, driven mainly by cost-push pressures, but more broad-based pricing pressures are beginning to emerge. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, increased to 5% in June 2011, from 4.6% in May. As was the case in the previous few months, the main contributions to the inflation outcome came from food, housing and utilities, and transport categories, which together accounted for 3.6 percentage points of the 5% outcome in June. Food price inflation continued its marked upward trend, measuring 7.3% in June from 6.3% in May. Petrol and electricity prices increased at rates of 21.4% and 19% respectively in June. Administered price inflation, excluding petrol, was unchanged in June at 9.3%. The underlying inflation trends have remained relatively modest. In May and June, CPI, excluding food and petrol, measured 3.7% and 3.9% respectively, while CPI, excluding food, petrol and electricity, measured 3.2% and 3.5% in these months. Year-on-year producer price inflation has displayed some volatility in recent months, partly a result of commodity price fluctuations. Producer prices increased by 6.6% and 6.9% in April and May, compared with 7.3% in March. Price increases in electricity and products of petroleum and coal were major contributors to the PPI outcome, but there were also significant increases in food prices, which had until recently remained subdued. Agricultural prices increased by 6.8% in May from 2.1% in April, while manufactured food prices increased at rates of 3.4% and 4.8% in April and May respectively. The inflation forecast of the bank has shown a slight near-term deterioration since the previous meeting of the MPC. Inflation is now expected to breach marginally the upper end of the target range in the final quarter of 2011, and to average 6.3% in the first quarter of 2012. Thereafter, it is expected to remain at the upper end of the target range for the next 2 quarters, before declining somewhat in the final quarter of the year. The forecast period has been extended to the end of 2013, and inflation is expected to decline gradually during the year, and to measure 5.6% in the final quarter of 2013. The bank's forecast of core inflation shows a moderately rising trend, peaking at around 5% in the second quarter of 2012. Inflation expectations for 2011, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University, had been declining for 6 consecutive quarters, but remained unchanged in the second quarter of 2011. Expectations for 2012 increased marginally, but remained within the target range, and declined for 2013. The average inflation expectation for the 3 main categories of respondents was 5.3% for 2011 and 5.8% for the next 2 years. Inflation expectations, as measured by the Reuters survey of financial analysts, showed very little change when compared to the forecasts at the time of the previous MPC meeting, with inflation expected to remain on average within the upper end of the target range until the end of 2013. Inflation expectations, as reflected in the break-even inflation rates of the inflation-linked bonds, moderated slightly since the previous meeting. The MPC assesses the risks to the global economic environment to be on the downside, and continued weakness in the US and UK economies has extended the likely duration of monetary accommodation, particularly in the face of declining fiscal stimuli. Risks relating to debt sustainability in peripheral Europe have intensified, with further rating downgrades to some countries. The focus has also moved beyond the periphery to larger countries such as Spain and Italy. As long as the sovereign debt crisis is unresolved, confidence will not be restored, and periodic bouts of risk aversion can be expected to contribute to a high degree of volatility in financial markets. There are concerns that a disorderly write-down of this debt could have systemic implications because of the high exposure of European banks to the debt of these countries. By contrast, there are encouraging trends in other parts of the world. The reconstruction of the Japanese economy in the wake of the natural disasters has begun to have some positive impact on that country's growth rate. Growth in emerging markets has generally remained strong, and fears of a marked slowdown in Chinese growth have been allayed somewhat by a robust second quarter growth performance. Global inflation has been driven primarily by oil and food price developments. There are, however, some indications that these price pressures may have peaked. Both the IMF and Food and Agricultural Organization food price indices show a flattening out since the beginning of the year. International oil prices have contributed to, and in turn have also been constrained by, the slowdown in global growth. The bouts of risk aversion relating to developments in the euro area have impacted on the volatility of the rand exchange rate. Since the previous MPC meeting, the rand has fluctuated within a range of 6 Rand 67 and 7 Rand 2 against the US dollar. The current level of the rand exchange rate against both the dollar and the euro is more or less unchanged since the previous MPC meeting. In recent months, the rand has also been affected by a number of actual and expected direct investment transactions, as well as by net purchases of bonds and equities by non-residents, totaling around 32.6 billion since the beginning of May. Net bond purchases by non-residents amounted to 34.1 billion, while net sales of equities amounted to 1.5 billion. From a macroeconomic perspective, the rand has remained relatively strong despite heightened global risk aversion and despite continued purchases of foreign exchange by the bank with the support of the National Treasury. Between September 2009 and August 2010, the rand-dollar exchange rate fluctuated in the range of around 7 Rand 40 to 7 Rand 80. Since September of 2010, the rand has generally traded in the range of around 6 Rand 60 to 7 Rand, apart from a short period in early 2011 when it breached the 7 Rand 20 level. While domestic economic conditions continue to strengthen, the recovery itself remains fragile, with mixed outcomes across sectors. Annualized GDP growth in the first quarter of 2011 measured 4.8%, driven primarily by a 14.5% growth in the manufacturing sector. This performance is not expected to be sustained in the second quarter. The monthly data for manufacturing sector output in April and May suggests that unless there is a major upside surprise in June, the positive contribution of the sector to second quarter growth is likely to be minimal. The Kagiso PMI, while still indicating positive growth in the sector, has declined for 3 consecutive months. Some of the slowdown in manufacturing can be ascribed to temporary factors, such as the impact of the earthquake in Japan on the global motor industry supply chain. The outlook for the sector will also be influenced by developments in Europe, which is a significant market for South African manufactured exports. Growth in the physical volume of mining production was also weak in April and May. Growth in gross fixed capital formation improved in the first quarter of 2011 to register an annualized growth rate of 3.1%. This was mainly due to the higher levels of investment by public corporations. Growth in private sector fixed capital formation, while rising, was still subdued at 2.7%. Despite the expected growth slowdown in the second quarter, the forecast of the Bank for GDP growth in 2011 and 12 remains unchanged at 3.7% and 3.9% respectively, while growth in 2013 is expected to average 4.4%. With a potential output growth rate of around 3.5%, The estimates of the bank show that the output gap, although closing, is still negative at around 2.5%. This is consistent with the fact that the levels of output in both the manufacturing and mining sectors are still below pre-crisis levels, as is the level of capacity utilization in the manufacturing sector. Business confidence, as reflected in the RMB-BER Business Confidence Index, reversed its positive trend when it declined to below the neutral 50 level in the second quarter of 2011. Confidence in the construction sector remains at an extremely low level, and the real value of new building plans passed declined further in April. Household consumption expenditure, which grew at an annualized rate of 5.2% in the first quarter of 2010, has been the main driver of the domestic growth recovery. There are indications that this growth may have moderated in the second quarter. The robust growth in real retail sales in April was more than offset in May, when a month-on-month decline of 4.7% was measured, while the year-on-year growth rate was 0. New vehicle sales increased by 12.6% year-on-year, but declined by 4% in the second quarter compared with the previous quarter. The FNB-BER Consumer Confidence Index increased marginally in the second quarter of 2011, but remains below the levels reached in 2010. The MPC expects household consumption expenditure to be constrained by a number of factors, including subdued credit market conditions, high levels of household debt, negative wealth effects, and persistently high rates of unemployment. Growth in total loans and advances extended by the banks to the private sector remain relatively subdued and grew at a year-on-year rate of 5.5% in May, compared with 6% in April. Growth in other loans and advances, particularly general loans, was the major driver as growth in mortgage loans, the largest category of loans, was restrained at about 3%, in line with the weak housing market. The subdued state of the credit markets reflects in part the high level of consumer indebtedness, which measured 77% of personal disposable income in the first quarter of 2011. The ratio of impaired advances to gross loans and advances has remained at elevated levels for some time, but declined marginally to 5.73% in May. Wealth effects have been negatively affected by the subdued housing market. The various house price indices indicate that house prices are falling in real terms, although there appears to be some positive nominal growth. While the JSE Limited is at relatively high levels, it is vulnerable to correction in the event of a significant global slowdown. Although household net wealth to disposable income has recovered somewhat since the recession, it is still below the peak reached in 2007. Employment trends have been improving slowly. According to the Quarterly Employment Survey of Statistics South Africa, formal non-agricultural employment increased by 2.6% in the first quarter of 2011, compared with the first quarter of 2010. This represented an increase of 212,000 jobs, just over half the number of formal sector jobs lost during the crisis. The majority of jobs created have been in the public sector, and the recovery in employment in the private sector remains slow. Wage settlement rates have been declining, with Andrew Levy Employment Publications reporting an average overall wage settlement rate in collective bargaining agreements of 7.5% in the first half of 2011, compared with 8.2% in 2010 as a whole. Similarly, nominal unit labor costs, which account for productivity changes, moderated to 5.2% in the first quarter of 2011 from 7.7% in the fourth quarter of 2010. However, given that most of the wage negotiations take place in the second half of the year, and that some of the recent high-profile settlements appear to have reversed this moderating trend, this positive outcome could change. Should these higher trends set a precedent for other wage settlements, this could represent a significant upside risk to the inflation outlook. The high trends in executive remuneration increases are also cause for concern. Food and oil price developments remain the major risk to the inflation outlook. As noted above, international food prices appear to have leveled out. Domestic food price inflation has lagged global trends, and further increases can be expected in the near term. However, these increases should be constrained should the favorable global developments persist. The price of Brent crude oil, currently at around $117 per barrel, is at levels similar to those prevailing at the time of the previous meeting of the MPC. The price has experienced some volatility in recent weeks, particularly following the release of oil stocks by the International Energy Agency in June, when the price declined to $106 US dollars per barrel. Although supply conditions are expected to remain tight, further upside potential is likely to be constrained by the uncertain global growth outlook. These developments allowed for a 31 cents per litre reduction in domestic petrol prices in July, following a 2 cent per litre decline in June. However, an increase is expected in August. The view of the MPC continues to be that the underlying inflation pressures are mainly of a cost-push nature, notwithstanding signs of possible moderate increase in underlying inflation. Despite the upside risks posed by cost-push factors, the MPC sees a number of downside risks to the inflation outlook, with the risks being seen to be delicately balanced. These risks include the continued fragile nature of the domestic recovery, as well as risks posed by the ramifications of a possible disorderly debt default in the Eurozone. It is, however, recognized that should there be unexpectedly high inflation outcomes, particularly with respect to underlying inflation trends, this could impact negatively on inflation expectations, which to date appear to be relatively well anchored. For this reason, the MPC is not complacent and will remain vigilant and continue to monitor closely any indications of second-round effects on inflation emanating from these cost pressures, as well as the changing risk profile of the inflation outlook. In light of the above, the MPC has decided to keep the repo rate unchanged at 5.5% per annum for the time being. The MPC will not hesitate to respond timeously to signs that threaten to move inflation out of the target range on a sustained basis. Thank you. Allow me, as we open for questions, to introduce, I think we have one new member on the panel today, and is a member of the MPC, and that is Deputy Governor Lesetja Kganyago. So welcome, and I'm sure that you're going to have a long, good few years of dealing with monetary policy matters, and so we look forward to your contributions, as well as to the rest of the work in the bank. I think everyone else who's present are members of the MPC, and you are familiar with them. And we are now open for any questions that you may have. Obviously, as is usual, they will also be referred to any member of the members of the Monetary Policy Committee to respond to. Can I just again ask you for record purposes just to introduce yourself?
Mary Misa from Business Day. Thank you, Governor. My question is related to the European debt crisis. South Africa's exposure to the debt of these European countries is really very low. So direct fallout from the crisis is not likely. However, should it spread and become global and systemic, what can South Africa do to protect its financial system from being affected?
I think that, really speaking, the challenges or what we can do is something that obviously between the bank, the National Treasury, we are discussing, we certainly are looking very closely together at what will happen. But it depends on what happens, what we can do. I think that really speaking, we have, as you've said, very little exposure. The challenge that there is in a crisis of the nature that we're seeing in the Eurozone is that it can be triggered by a number of things and it can take different forms. The primary question here is not just the exposures and the debt and the sovereign debt of the peripheral countries, and as we've seen, moving to Spain and Italy, but it is the exposure of the banking sector. And I think that is the concern that is really underlying the issue, is the exposures of the banks across Europe, and certainly exposures of US investors into European banks. That is the cause for concern. And I think that, as you know, the ministers are meeting today. There's been a meeting between Angela Merkel and Nicolas Sarkozy to look at what can be done. And there's no question that the European leadership, certainly from the central bank side, that we are aware of, are looking at this with what can be done. So it's a matter that constantly we would be looking at exactly what form it's taking, what is happening, what is the deterioration, or the solutions that are being offered, and be ready to respond appropriately as it materializes, or preferably does not materialize. But obviously it's of extreme concern. Yes?
Renee Volgra from the Sunday Times, Business Times. Governor, I would like to know whether the MPC has considered the impact that a disorderly debt default might have on the value of the rand, given that the rand has been mostly influenced by international factors over the past 2 years.
I would like everyone to be able to tell us what influences the rand, because if you look at it during the period of time when in actual fact there were outflows earlier this year, the rand strengthened. So the question for us is, what is the nature of the crisis, what will happen, and the impact of the rand, it can be to strengthen or to weaken depending on the nature of what occurs. So for us it is a question that as things have stood, the rand has in fact strengthened. And either way, you need to look at what flows to emerging markets are, and at the moment they're continuing very vigorously. But it is a question that in dire circumstances, I think it's conventional wisdom that the dollar, I'm not quite, well, maybe it's called the familiar rather than the safe. But so it's an unknown question, really speaking, but it is certainly a factor that we would keep a very close eye on. And at this point in time, the rand is trading within a particular range, and there has been no evidence of that changing. The best result, of course, is that there isn't a disorderly engagement there. Yes?
Good afternoon, Governor. Nompumelelo Siziba from Summit TV. Governor, how concerned are you about the wage settlements that are taking place in the second half of this year? And you also alluded to executive remuneration. I know it's not your job to be prescriptive, but what sort of levels do you think executives should be setting themselves?
I don't think it's appropriate for me to answer the levels. I mean, we're clearly indicating that the levels that have been reported on are really need to be re-examined quite considerably. It depends. I think if you looked at it, part of the growth path was to try to get a cohesion between government, business and labour and a pact going forward, and I think that is the route to go, and would encourage that to be looked at. As I've indicated, I don't think there's anything to add to the statement other than to say that there has been a positive trend, and the levels of settlement need to take account of where inflation is and the environment that we live in. And obviously, I don't think there's really much to add to what we've said here. I don't know if anyone would like to add anything. Yes, sir.
Tshepo Moy from SABC News. With core inflation at 3.5, was there concern that perhaps maybe inflation is becoming more generalized? That's one. And secondly, did the MPC discuss the current wave of industrial actions and its impact?
Would somebody like to deal with either of those? Core inflation, wages, XP?
I think in the deliberations of the committee we take a look at a vast range of information. Core inflation is obviously one of the factors that one would have to examine, always remembering that there are different definitions of what is included and what is excluded in core. The overall decision was that the behavior of core is not such as to threaten prolonged exit from the target range, and that together with a range of the other information persuaded the committee to the decision that it has taken.
Anyone would like to deal with the labour dispute? I really don't think there's much to add to what we've said in our statements. We're obviously noting the settlements with concern and with interest, but these are matters that happen in society, and it's up to labour, government and business to sort themselves out in that regard. Yes, sir.
Franz Wild from Bloomberg. Sorry, if you will bear with me, it's just another question regarding the wage settlements. I have seen that you said that in the first half of 2011 there's been a declining trend. Do you expect that declining trend, in light of the current negotiations that are still ongoing, do you expect this positive trend, or the declining trend rather, to be maintained, throughout the year, or do you expect it to kind of revert to levels we saw in 2010?
I don't want to add much more than what we've said in the statement, because really speaking what we're saying is that the majority of settlements take place in the second half of the year. A lot of these settlements are multi-year, and that given what we've seen the settlements at this point in time, we would be concerned that they would affect that declining trend, and we are pointing to that they should not set a precedent going forward, because it is hugely important that if you look at your administered prices, if you look at all of these areas, the level of wages form part of what is happening there. It's taken into account, and therefore wages are a significant factor that pose an upside risk. Helmut?
Thank you. Helmut Preuss, The New Age. Governor, just in terms of definitions, you use the bank's forecast of core inflation. Could you just define what core inflation is in terms of the inflation? And then the output gap, you say, is about 2.5, and potential is 3.5.
Potential growth.
Yeah, I look at it as being, if you've got an output gap now and we're running at 4.8, then potential growth is closer to 6.5. Am I correct in that assumption? And then you say also that mining was weak in April and May. We had growth of 12% in April and 9% in May. So that doesn't seem to gel. Thanks.
Brian, would you like to tackle some of those?
Yeah, I think the potential output is the level of the the potential output is, as we indicated, is around 3.5%. That's the maximum non-inflationary growth if you're already at full employment. But at this point in time, we do have an output gap. So in other words, the level of output in the economy is lower than what it potentially could be. So that's the level. In order to close the gap, you have to be growing at rates higher than potential in order to close that gap. We still see us having that gap, and we still see that gap will be there for some time, although it is closing.
Wanda?
I think the question on the core inflation has already been answered by Dr. Guma, that we look at a number of variants of inflation. That would include the exclusion of food and energy prices, inclusion of food, energy prices, and admin prices. There are just quite a number of them that we look at. We don't look at one variable.
Rashad, anything on the mining?
Helma, I'm not sure what you're saying. You're saying that April to May is slower than March to April. Right. Okay, can we look? We don't have the data yet. Can we discuss that?
If I can add a little bit, I think it was also comparing to the first quarter, where the mining production was relatively positive and was growing stronger than in the second 2 months of the second quarter.
No.
Two very quick questions. Was this decision relatively straightforward, or was it difficult? And what is the main threat to the inflation outlook right now?
I don't think any decision is straightforward. I think that whether you move up, down, or don't move, they're all equally considered decisions. So a question of deciding to stay where we are is not a fallback position that you simply say, oh, we're not. It's a considered decision. And therefore, in that sense. I think that what we're also saying is that the upside and downside risks are very delicately balanced at this point in time. So it can't be an easy decision if you are weighing things that have a pretty even balance. So I don't know if that answers you for that question. Your second question was, what is the main threat to inflation at this point in time? I think we've again clearly indicated that we're concerned about the levels of administered prices and the drive in terms of food and oil, which are the main issues. If you look at food, oil, electricity, energy, those are what's driving a lot of the inflation. And it is compounded by the concerns that you have about what is happening globally, whether it is the U.S. debt ceiling debate. We hope it's a debate that doesn't become a debacle, and that in the Eurozone how the sovereign debt issue is being resolved and not being patched. So all of these things impact one way or the other on your decisions and your outlook for inflation. Yes, sir.
Governor, just similar to Mariam, the decision, was there any consideration for either a rate cut or for an increase?
No. I think it was, first of all, it was a unanimous decision about of not increasing. A discussion around decreasing did not feature as a question of saying that is what we should consider. So no, it was neither at this point in time. Everybody's view was that holding is the right position at this point in time. Yes, at the back.
Governor, we have 3 questions via the webcast. Question 1 is from Alfred. In the current low-growth environment, at what level would actual inflation deterioration prompt the SARB to remove some policy accommodation? Question 2 is from Mr. Beloy. What would the MPC's response be should you foresee the inflation rate potentially breaching the upper limit of the target range in future? Question 3 from Brett House. Why was the inflation forecast raised? Thank you.
I'm going to ask colleagues to address them. Who would like to start?
Well, I think on the second one, it's also probably in the statement that we definitely might breach the target range in the fourth quarter of this year, going up probably to the second quarter. And therefore, we take that the policy stance that we have already taken has taken that into consideration, and that's why we decided not to move the policy rate at this time. I didn't hear the first one.
Explain.
Yes, the concern about whether this is a rigid or a flexible inflation targeting regime is encapsulated in that question. And I think it would depend on the view of the committee as to whether this is a temporary or a more permanent breach of the target, either above or below. That is, below 3 or above 6%. So that would be the judgment that the committee would have to form, and a change in the monetary policy stance would be predicated upon obviating the difficulties of a sustained absence from the range.
Brian?
On the question of why the forecast was raised, I think it's important to just note that it was a very marginal change in the forecast, probably more to do with technical factors than anything else. I think it was something like a 0.2% increase in the fourth quarter, and that could have been for a number of factors, including maybe minor changes in the assumptions over the period, or also because of new data that came in, actual data, which then got incorporated into the forecast. But it's really not a material change in the forecast that we saw.
I'm not sure that we've answered the first question. Can you just give us Alfred's question again?
The first question, in the current low-growth environment, at what level would actual inflation deterioration prompt the SARB to remove some policy accommodation?
Ms. Setcher?
Of course, what you can't do in setting out policy is to worry about month-on-month movements. You've got to ask yourself what you are seeing as the trend in inflation. And in considering that, I think that XP had covered it quite nicely, is that you've got to consider all the factors that contribute to inflation and ask yourself as to whether the breach in the inflation target is a temporary one, or whether it is a longer-term one. Of course, if it is a longer-term one, you are going to have to take particular steps. The consideration of the committee in this meeting was that we expect that the inflation target will be breached in the last quarter of the year, but we do not see it as permanent, hence the decision of the committee today.
Other questions? We'll start again with you, Helmo.
Governor, have you got an opinion from your auditors as to what to do if there is no US debt ceiling increase? Would you have to write down your reserve assets?
I think, Helmo, let's cross that bridge when the US lets it fall, okay? I think that obviously we're considering what the situation is and what we would need to do. But I think it would be a little premature for us to be looking at the detail of that. I'm quite sure common sense, or I'm very hopeful that common sense will prevail in the end in the United States. If it does not, I think the words used by President Barack Obama was Armageddon. And I think there would be a whole lot of issues that would have to be looked at by everybody in that circumstance. So I do hope that wisdom will prevail there, and common sense. Yes.
My question actually links to what Helmo asked you, but it's not just only about the US, but it's also about Europe. How confident are you, given what the global ramifications, how confident are you that there'll be a settlement in terms of increasing the debt ceiling in the US and also sorting out the debt issues in Europe?
I don't think it's appropriate for us to say how confident we are or otherwise that they will find solutions. I think what we're raising is that it is a very grave situation, and that the wisdom of the United States leadership and the wisdom of the Eurozone as a whole needs to pay attention to this, because which they are doing. There's a meeting right now of leaders, there's constant meetings of the ECB, there's interactions that are ongoing, and therefore it's not about how confident we are they would find a solution. What we're drawing to the attention of South Africa is that these are very, very serious matters, and therefore we as a country need to look at what we should be doing to ensure that the fallout, because even if they find solutions, right, there's still a very long period of recovery. So even if we assume they find solutions and it's able to be sustained and there's a managed difficult process out of your sovereign debt crisis and you have a debt ceiling resolution, there's still a very difficult prevailing economic circumstance, both in the US and in Europe. And therefore this is heightening the risk issues, but we need as a country to be paying attention to just how grave the situation is and how the concerns that you have going forward is for a considerable period of time. So even if they find resolution, we still have a very difficult economic climate to face. Yes?
No, Ola from Reuters here. It seems you've revised your growth forecast for 2011 upward slightly to 3.7%. But the statement from the previous MPC said it was at 3.6%.
I'm not sure. I thought we had revised it up to 3.7. I didn't think that we had revised it upwards now. There's certainly, as far as I can recall, no change in our growth forecast for this year or next year. At the back? Sorry, let me just check, but that's my... We didn't change that, no. Yes, at the back.
Governor, a question via the webcast. Peter are real rates low enough in order to ensure sustainable growth is reached in domestic demand, or is more action needed on the monetary or even fiscal side?
I think on real rates, I'll ask one of my colleagues to just explain that. But certainly real rates at the moment are negative 0.6.
If we're looking at real rates relative to the policy rate,
Yes.
to the repo rate is currently 5.5%. If we want to derive a real repo rate, we subtract the expected inflation rate. So if your expected inflation rate, say, over a year's time is between 5.5%, your real rate is almost zero. Whether or not this is low enough to stimulate the economy, I suppose implicit in our stance at this point in time is that we think that these rates are low, but they are not likely to result in excessive inflation in the short run anyway. But whether or not they are sufficient to bring about sustainable growth, we don't know at this point in time. But the fact that we haven't lowered rates further implies that we think that they are appropriate at this point in time at current levels.
And just to add that, bear in mind that these rates are the lowest they've been in 30 years. So, this is not necessarily an inhibiting factor.
Sorry, Governor, just to add to what Kola said, I'm just looking at our story from the last MPC, and we seem to have the same, that it was 3.6, yeah.
3.6, 3.7, I'm sure it's not statistically significant. I think the general trend is pretty much the same as what was the case for 2011 and 2012.
Mary?
Last time you predicted that the inflation would be outside the target range for 1 quarter. This time it's 2 quarters. How long would it have to be outside the range for you to see the breach as sustained or permanent?
The breach at this point comes slightly earlier. So it is occurring at our forecasts indicate that it will occur at the 4th quarter of this year and be there for 2 years coming in thereafter. The question of sustained is if we don't see the trend coming back. It's not the question of, would it be 3 quarters outside? You'd certainly be looking at it more closely. But what I've indicated earlier is that there are indications that there are broader inflation trends coming through. We are concerned about it, but the balance is very evenly weighted at this point in time. And we have indicated that it is, as I said, going through the ceiling slightly earlier, and we will watch it very carefully. Any other questions? Any other comments that anyone would like to make? Daniel?
On the last point, I think importantly as well is that one doesn't just look at that one particular variable to say how long is it outside and all that. It will have to do as well with the interplay of other factors, and obviously the very important one is the impact of any such use on inflation expectations.
Sorry, I didn't hear that. The impact on what?
But bear in mind that when we're looking at this, your issues are quite a number of things that you're looking at. If you looked at what we're really emphasizing here is the global outlook has deteriorated considerably. And therefore, you cannot look at numbers or issues around inflation without taking that into account, because whatever happens within that is certainly going to impact on inflation one way or the other, which is why we've said throughout the statement that it's an evenly balanced risk that we will be watching very carefully and take the necessary measures. But it is a very, very difficult situation that the globe finds itself in. Helma.
The last time that the Reserve Bank raised interest rates was in 2008, where a lot of the price pressures were coming from demand pressures, and then that changed with the Lehman collapse. This time around, it seems to be more in terms of supply disruptions. We've had the earthquakes, we've had volcanic ash clouds, we have an Atlantic hurricane season coming along, we've had Libya, Middle East, etc. The response this time, because it has been supply disruptions and therefore the Reserve Bank monetary policy would have no impact on that, is that one of the reasons why we've had a sustained period of stable interest rates?
Well, bear in mind that it's not just, this has been stable interest rates for quite a while. So a lot of these things have different weightings, and as I said, I think the situation has deteriorated considerably in the very recent period. But yes, the fact that interest rates do not necessarily or do not impact on your oil price or whatever is hugely important, which is why we're saying we're very closely monitoring second-round effects and would act accordingly. So yes, you're correct. Everyone, thank you very much. Thank you for coming. We look forward to seeing you in September. That is our next meeting, isn't it? And by then, I hope we have more clarity on a whole lot of things. If not, I have no doubt we would see you before then. Thank you all.